Hello everyone and welcome. I'm Professor Boucher and today we're going to be getting into the basics of managerial accounting. So let's start. What is managerial accounting? Managerial accounting is a bit of a difference from financial accounting, which you may have worked with before. One of the biggest differences is that financial accounting looks at transactions that happened in the past and is mostly prepared for people outside of the organization. Managerial accounting, on the other hand, is prepared for the managers in the business. We're going to use future information like estimates and things like that to come up with ways for us to plan our business operations to continue to be successful in the future. One of the big things that we're going to start learning about is work in process. Work in process is something that we've started but haven't quite yet finished. Working within managerial accounting, we're going to be learning about new things like direct materials, which would be something like clay for a mug, or direct labor, which would be an artisan crafting a beautiful coffee mug for us. And then we're going to learn about this kind of a catch-all thing called factory overhead. That's going to include anything to do with manufacturing, but that isn't directly traceable to that item that we're producing. Let's go ahead and jump into a problem. Now this problem builds upon what we just talked about, breaking our costs further into product costs and period costs. We see that the product costs are going to be the items that are directly related to the items that we're making, which consists of direct material, direct labor, and factory overhead. And then we also have period costs. Period costs are going to be the items necessary to run the business, but not directly attributable to the manufacturing operation. Think of something like an HR manager or an accounting team. Necessary for the business, but they don't actually put their hands on the goods. When working in managerial accounting, it's important to understand that the business that you're speaking about. So this problem that we're going to be working on lets us know that they are a picture frame business. That's going to be important for things that would end up being direct materials for them that may not be direct materials for someone who manufactures, say, a coffee mug. We're going to identify if each one of these given items here would be a product cost or a period cost. And if it's going to be a product cost, would it be our direct material, direct labor, or factory overhead? Starting with glass. Again, we are a picture frame manufacturing company, so that is going to be a direct material. The glass is going on the outside of our picture frames, and it is integral to the product that we are making. The next one we have down here, the senior accountant's salary. Well, they don't have anything to do with the actual manufacturing process, so they are going to be a period cost. We'll slow down here and talk about period cost again for a second. The difference between a period cost and a product cost, other than how they're derived, is when they are ultimately expensed. So a period cost is going to be expensed in the period that occurred. So we paid this accountant's salary in December, we will expense this cost in December. Versus a product cost. These are capitalized costs. That means these costs are going to be put into an asset, largely work in process. Once they're completed, they'll be moved into finished goods inventory, and ultimately they will be expensed through cost of goods sold when we finally sell them. The next one we have here is glue. Glue is going to be a factory overhead cost. The reason being here, we might be tempted to think that it is going to be a direct material, but direct material is going to be something that is measurable and integral to the product that we're making. Glue, not so much. Wood, that is definitely going to be a direct material for what we're doing. After that, we have depreciation on an industrial miter saw. That ends up being factory overhead. Definitely required for the production of our goods, but I don't really know how much of it goes to every single picture frame, so we put it into factory overhead. Our assembly workers' wages, that is direct labor. If they're on our assembly line, they are directly manufacturing our product. Our shipping fees to our customers, those are going to be a period cost. And lastly, depreciation on customer service office furniture. Again, our people in customer service, while they do help us sell items, they don't help us manufacture them. So that's part of our period costs. All right, that's just kind of a quick exercise to be able to identify how certain items are going to make their way onto our balance sheet and income statement. Next, we're going to move on to a cost of goods manufactured statement. That's going to give us a little bit more information about how items and costs are flowing through our organization. So let's take a look at that now. The cost of goods manufactured statement relies on the basic premise of managerial accounting. So we're going to be taking into account our direct materials, direct labor, and our factory overhead to calculate how much goods were actually manufactured this period. We're going to start with direct materials. We're going to have to calculate how much actually went into production this period. So we're going to start with what our beginning amount of raw materials is in our storehouse. And in our case, it's going to be the $15,800. Then from there, we're going to take into account what did we add to our storeroom this period? And that's going to be reflected in the raw materials purchases. In our case, it's going to be the $66,000. That is going to give us raw materials available for use. And to get that, we add the two of those together, telling us how much went into our storeroom for the period. Then we're going to go ahead and take our ending inventory, which for us is this $10,200. That tells us what was left in the storeroom at the end of the period. And this is going to give us our direct materials used or put into production for us. And we take the total that was available and subtract from that the amount that was left over. And that gives us $71,600 that were put into production. For us, we're only going to have to calculate that one item. The rest are going to kind of be given to us. So the next thing that we take into account is our direct labor. And it's telling us that our direct labor is the $43,000. Then we're going to take into account our factory overhead, which they also told us is $60,000. This leads us to our total manufacturing costs, which is calculated by taking our direct materials used plus our direct labor plus our factory overhead. And that gives us $174,600. This represents what was put onto our production line this period. Now we're going to go ahead and take into account what was on our production line when we turn the lights on, which is our work in process inventory beginning. They're telling us that our work in process inventory beginning is $29,000. That's going to tell us what our total work in process was. So we're going to take what we added to the production line this month plus what was already on the production line, giving us $203,600. Then we're going to do a similar process and take what is my ending work in process, which for us is going to be $44,000. And we are going to subtract that from our total work in process because, again, these are the items that are not yet finished. They're still somewhere on our production line, which will give us our cost of goods manufactured. We're going to do a little bonus on this one, where what we're going to do now is calculate our cost of goods sold. This is going to feel kind of similar to what we ended up doing with our raw materials above. But instead of raw materials, we're going to take our finished goods inventory, which for our case is going to be this $20,000. We're going to add to it our cost of goods manufactured, which is that $159,600 that we just came up with. We're going to add them together to get our cost of goods available for sale, giving us $179,600. Then we're going to take our finished goods ending inventory, and we are going to back that out of here. So our finished goods ending inventory was $37,400. That will ultimately give us our cost of goods sold, which is our $142,200. Again, this is just kind of like a microcosm of what we did for direct materials. You'll see that through managerial accounting, this process is very common. You start with your inventory. You add to it either purchases or items transferred in. So for us, we had our finished goods inventory of $20,000. We transferred in cost of goods manufactured of $159,000, telling us that our finished goods total available at the time was $179,600. Then we're going to say we took an inventory count at the end of the period, finding we had 37,400 products still left in our finished goods warehouse. The difference between the two of those, since they're not here anymore, would have to represent the cost of goods sold, in our case, $142,200. The next problem that we're going to look at explores the cost flow relationships. It's mostly being done so that we can see how these items relate back to each other. If we have one, more likely than not, we can find another. So let's go ahead and give it a try. The first cost flow relationship we're going to work on is cost of goods sold. You'll probably remember that cost of goods sold was used to find gross profit, where we would take sales minus cost of goods sold to get to gross profit. In this case, we don't have cost of goods sold, but we do know the other two components. We see that the sales of space pencils were $792,000. We also see that our gross profit was $462,000. We're still going to subtract them, giving us $330,000 for our cost of goods sold. The next one we're going to move on to is finished goods inventory at the end of the month. Now, there's something important for this one that's allowing us to kind of take a shortcut here. The problem is letting us know that this is the first month of operations of JW Company, meaning that there is no beginning inventory. So we can just assume the beginning inventory is 0. But given the information we have here, we know that we have our cost of goods manufactured. Those would be transferred into finished goods. And then the cost of goods sold reflect the items that were transferred out of finished goods inventory. So again, here in our case, cost of goods manufactured are $396,000. Cost of goods sold are what we calculated above, the $330,000. We'll take the difference between those two, and that's going to go ahead and give us $66,000, which gives us the amount of our finished goods inventory. Next, we'll do the direct materials cost. Similar to like what we did before, but this is the first month of operation, so there is nothing existing in here. We're going to go ahead and start with total materials purchased. And then we're also going to go ahead and take our materials inventory ending. The costs for these, material purchased is $244,000. Materials ending inventory was $33,000. And then we'll take the difference between the two of them. We come up with $211,200, which recognizes our direct materials costs. Next, we're going to calculate the direct labor cost. Now remember, direct labor cost is one of the 3 components of our cost of goods manufactured, which include direct materials, factory overhead, and direct labor. So let's start with the items that we know. Up at the top, it told us what our total manufacturing costs for the period are. In this case, they're going to be those $455,000. What we also have is our direct materials costs, calculated above. And we calculated our direct materials costs to be the $211,200. This problem has provided us with factory overhead costs. Now, factory overhead is going to be those indirect costs. In this problem, there's 2 of them. We've been given indirect labor and factory depreciation. So we need to add both of these together. The $26,400 plus the $171,600 to come up with factory overhead costs of $198,000. I'm just going to come over here and total those two, coming up with $409,200. The difference between the total manufacturing cost, which was everything I put into my production line, the $455, and the $409,000 of direct materials and factory overhead, represents my direct labor costs of $46,200. And lastly, we're going to calculate the work in process inventory at the end of the month. Remember, for this business, it's our first month of operation, so there is no beginning inventory in work in process. That means that we're going to start with our total manufacturing costs for the period. This represents all of the items that went into production for this month. Then we're going to take into account the cost of goods manufactured. This represents the items that were completed and transferred into finished goods inventory during the period. For us, we're going to take the difference between those, what was put into production minus what was finished, and that will leave us with a work in process inventory of $59,400. Thanks for hanging out and learning a little bit about managerial accounting with me. I hope to see you guys again on the next one.